Hey, what's up guys? This is Juan Pablo from 100% Finance at 100%finance.com. Checking in with you guys, Mr. Cash Flow, Mr. Infinite Return on his investment, because I do my deals 100% finance, as should you, right? Because I'm here to teach you guys. So today's topic is basically showing you guys how to get multifamily properties, multifamily buildings, apartment buildings, 100% finance without using your cash and credit. Can you do it? Yes, you can, and I'll show you how. Because as a disclaimer, the things I teach you guys are things that I am doing or have done. Okay, so nothing is theories and there's no hypothesis involved. It's actual things that I'm doing, and I'm actually doing something like this right now as we speak. So stay tuned. I'll keep you updated. But this is basically teaching you how to get multifamily properties without using your cash or credit. So here's the first thing you need to do. You need to find a good multifamily realtor. A realtor who deals solely with multifamily properties. How would you find this realtor? Same way I found my realtor. I went to loopnet.com. LOOPNET.com. They have a bunch of multifamily properties there. Some of it is crap, the deals they have on there on the website. It's basically like the MLS, multiple listing service for commercial properties. However, I just go there solely just to scout out realtors. So I contacted about 20 realtors, 25, as should you. Listing agents, these are people who list the property for sale, who work with the seller. And I gave them all a cold call, pretty much. And out of the 25 people I called, and again, I did this a couple years ago, I've done about 90% of them with just one. This dude is like a rock star in the Pittsburgh market. He's the number one multifamily realtor in Western Pennsylvania. I wouldn't know that unless I just cold call all these people and found a rock star who always is sending me leads. You know, before they even come on the market, it's called a pocket listing. Hey Juan, would you like this? This fits your criteria. Bam. Yeah, I like it. Come on, let's get on the contract. Bam. And then we close, you know? So that's what you want. You want to have a good realtor, a rock star realtor on your team to give you pocket listings. However, you got to make sure that you come with it, because a lot of realtors, they deal with what I call tire kickers. You know, people that just waste your time. They're interested in getting into the real estate game. They talk a smooth talk, but they're about nothing. So to add clout or credibility to yourself when contacting these realtors for the first time on loopnet.com, you want to make sure you have like a proof of funds and make sure that you're pre-qualified, okay? Which is get a pre-qual letter from a mortgage company. So even if you don't have the credit for pre-qualification or even have the cash in your account for proof of funds, you got to get it from somebody, okay? That's the point of partnering. You're strong where someone else is weak and vice versa. So someone is strong with the credit, someone strong with the pockets, having deep money in their bank account, you need to partner with them, okay? And what do you bring to the table? This, how to structure deals, how to find deals, how to analyze deals, how to manage deals. That's what you bring to the table. You got to bring something to the table, people, in order to do something 100% finance, all right? So realtor, or you can use ListSource. You can go to listsource.com and search for properties that are multifamily, 5 units or up, that have been owned maybe longer than 10 years, 20 or 30 years, so that you can find a potential seller or someone who could be a seller who may have a lot of equity or perhaps own the property free and clear, which we'll get into a little bit later. And you can mail them out a letter saying you're interested in buying the property and yada, yada, yada. Kind of like a direct mail campaign. Instead of targeting distressed single-family homes or pre-foreclosures, things like that, you're targeting people who own apartment buildings for a long period of time, who could be just a tired landlord. They're just ready just to cash out, pull out their equity, and move to Florida. There's a lot of people out there like that, okay? So you can do that. Second thing, so let's say you found a deal, right? A multifamily deal. You need to contact a mortgage banker or mortgage broker. I prefer dealing with small community banks, banks that are local. They're more apt to provide you with lending. I don't really go with the big banks like Bank of America or Wells Fargo. I normally go with a local bank, right? A community bank. And you have to get, normally for commercial, they might not give you a pre-qual letter, but at least just touch base with them, get rapport, and just ask them if they have a pre-qual letter. Ask them just based upon your finances if you qualify. If you don't, then you need to have a partner who does qualify. You have to find these people. There are people out there who will love to get a piece of the pie, a piece of the cash flow, a piece of the equity, and they're just bringing their credit to the table. Okay? So that's where we get to here, a partner. So if you don't have the credit, you need to partner with a credit partner. And this credit partner, when you create an entity to hold the property, depending on your state, it could be an LP, which is limited partnership, or it could be an LLC, limited liability corporation, whatever it is. Contact your attorney about that. That credit partner needs to have the majority stake. And you, my friend, need to have less than 19% ownership in that entity. Why? Because most banks, like commercial banks or these community banks that deal commercial loans for multifamily apartment buildings, what they do is they analyze the people who, well, they do not analyze the people who have less than 20% ownership. Okay, so what that means is if you have 19% ownership in an entity, they can care less about your credit or your W-2s or your tax returns. Their focus is on the person who has the majority share. Okay, so even though you might own 19%, it doesn't mean that you can only get 90% of the cash flow. That's separate. That's in regard to the profit share. We're just talking about here the equity. And that's what needs to be outlined in your operating agreement when you have your entity formed by an attorney. Again, whether it's an LP or LLC. So have 19% equity. And what you can do too is to avoid having putting up cash, you will put in sweat equity. Your expertise, your knowledge, your time, your energy, your efforts, your management skills will all be compensated. So you don't have to put cash up because you should be rewarded for that. If you're doing all the work and the other person's just a money partner or a credit partner, you need to be compensated for that. Okay? So that's where that 19% ownership can come from. And again, everything's negotiable. So you still can get compensated for that, for your time. And you can also say, or your partner can also say, well, you still need to put in additional money, whatever. It's just whatever you work out. Okay? So that is very important. If you don't have cash or credit, get a credit partner, get a money partner for the down payment, and make sure that you create an entity to hold the property. You know, when you're dealing with partners, you don't want to have it in your own name. You make sure you have less than 19% ownership. Okay? Just to fly under the radar so you don't have to get your finances analyzed by a mortgage banker or broker. So the down payment. So this mortgage covers 80%, right? Most commercial bankers will cover 80%, well maybe 70% to 80% of the purchase price. Now you got to come up with the down payment, which is normally 20% to 30%. How will you finance a down payment so you can get this property 100% financed, right? Which is the website. Well, what you could do is first, if the guy is the seller and he's elderly, let's say he owned the property for many years, over 10 years, hopefully 30 years, right? Or 20 years. He may own it free and clear. And you have to just find out what is his motivation for selling. He just might want to cash out, or he might just be a tired landlord. And who knows, he might have some money in the bank. He might not really need all that money up front. Again, this is assuming that he does not want to do 100% seller financing. If he does seller financing, you really don't need to get a mortgage. You might have to refinance to a mortgage later, you know, depending upon the terms you have for this loan. But let's say the seller says, all right, I'll give you a note, but if you do commercial, he can do up to 10%. So just to make the math easy, let's say you're buying a 5-unit apartment building for $100,000. That's the purchase price. The banks, they'll allow the seller to assist in regard to providing seller financing, which is a note, a loan that the seller will hold, as long as it's 10% of the purchase price. So if you're selling a property for $100,000, the seller can hold a note for $10,000, and then you have to come up with the rest, which is $10,000, assuming that the mortgage is 80% of the purchase price. 80% of $100,000 is $80,000, so you have to come up with $20,000. The seller will hold a note for $10,000, then you have to come up with the other $10,000. Okay, I hope you're following this. If not, email me and ask questions, and watch this video over again if you don't quite understand everything. Okay, so the seller will hold a 10% note. So how would you come up with the other 10%? You can come up with private money, your partner up here can say, yeah, I got 10,000 to do. Or they might be able to give you a promissory note. Okay, and you structure an interest-only note. Partner, which we have up here, or you can use business credit to finance that. Okay, which are all different ways. So the partner, you can have a private money guy, and you just give him a 2-month note, promissory note, and then you pay him off with the business credit after the loan closes, the whole deal closes with the bank. Okay, so that's how you can come up with the down payment. You can be very creative on how you come up with this. But just the point is, when you're using creativity, you're not using your own money. Okay? So you want to make sure you open your mind a little bit and ask questions. Seek mentors or contact me, because I also provide consultation services on a monthly basis. So you can contact me if you need help with brainstorming on how you can structure this deal so that everyone wins. And you're not using your cash or credit to do the deal, and you own multifamily property. So just to recap on the down payment, the seller, which you can do as an illustration, this is something I'm doing currently. You can have the seller hold a note for 10%, and you can structure the deal with the seller as, okay, lend me this $10,000, for example. I'll pay you 5% interest rate, interest only, just the interest. With the principal, it's called a balloon payment, with the principal due in 5 years. Okay? And the seller might, come back at you and say, all right, well, I'll do 6%, or I'll do 3 years, whatever it is. Take it. All right? So that'll be a lower payment. You might have to pay him a low interest rate. If you're borrowing $10,000, you might have to pay him like 60-something bucks a month, which is nothing. The private money guy, you might do the same thing. All right, for the down payment of also $10,000, I'll create the same terms. 5% interest only, 5 years, a balloon payment is due. Okay? So now your balloon payment with this guy, the seller, and with the private money balloon payment. Okay? This guy, the partner, you don't have to pay him back because it's equity, so he's getting part of the cash flow on a continual basis. In business credit, you have to treat it like these two guys, that you have to factor that minimum payment into the debt service. Okay, so you can pay that off. So now, what most people neglect, which is very important, is the exit strategies. The exit strategies basically, which is a way that you can exit out this deal, especially with the financing, the down payment, with the seller, the private money guy, and the business credit. You need to have at least 3 exit strategies, okay? So you always want to think about the back door before you come in the front door. In other words, you always want to think about how you're going to get out of these notes before you even sign on the dotted line, before the deal even closes. You always want to have at least 3. So one strategy would be the cash flow. So I'm actually doing a deal like this where I'm having the seller finance 10% and I have a private money guy financing 10%. Similar terms. The seller, I have a 6% interest rate. The private money guy, I have a 5% interest rate. And they're both have balloon payments in 5 years. So the payment collectively to pay these two is like $115 a month. So the cash flow will be about $600 a month. So one of the extra strategies is, if we're buying it with equity, we can cash out. We can do a cash out refinance in 3 years or 5 years, and use the equity that we pull out to pay these off. The only thing is, you never know what the property could be worth 5 years from now. You never know what the market will do. Even though it's commercial, you can kind of you can force the appreciation, things like that. You can tell what the property's worth based upon the NOI, the net operating income, and the cap rate. But you just never know, So that's one strategy. Do a cash out refinance closer to when the notes mature, which is 5 years for both of these guys. Second option is we can sell it. We can say, all right, if we don't happen to qualify for cash out refinance, or let's say the interest rates go up in 5 or 6 years when we do a cash out refinance and it doesn't work, then we can just sell the property outright, pay these guys off, and we just eat the capital gains, Or the third way is we could say, all right, since we're making $600 a month in profit, what we can do is we can pay off the seller first, don't eat none of the cash flow, just that extra $600 a month. We pay off the seller in 2.5 years instead of 5 years, and then we pay off the private money guy in the other 2.5 years, which it happens to work out that way. And we still keep reserves. I think we have about 15 to 20% reserves that are just stashed away for maintenance and vacancies. So you do that, plus an additional $600 a month, you pay these guys off. So within 5 years, We have both of these notes pay off. We have equity built in, and we can still do a cash out refinance. And my partner or I would just eat the equity from the cash out refinance, or what most smart investors will do, then reinvest that into another property. It's kind of like, you know, you just buy the chicken, eat the eggs. You buy the apartment building, but you don't eat none of the money you pull out of it, the equity. You reinvest it to buy another chicken, which is an apartment building, and you just eat the eggs, which is the cash flow, the profit you get every month from the rental property. All right, so that's just a quick way. I hope this makes sense to you guys. If not, watch this video over and over to make it sense. I have an ebook on you know, buying rental properties, commercial properties. But my friends, you can do this all day long. Just the key is you just basically being a networking genius, a transactional engineer. You just having multiple tools in your tool belt to finance this deal, as well as networking with realtors, with mortgage bankers, and with partners, private money. That's all you got to do. Just make sure people know what you do and that you're good at it. The most difficult part starting out is just establishing credibility, so people can trust your ability to do these things. So it is kind of wise if you improve your credit, get business credit, which we have business credit on the website, 100percentfinance.com. We have a free, it's like a small ebook to tell you about how to apply for business credit and qualifications. But you can use business credit to do some of your deals. So when you have a couple of deals under your belt, people will trust you, because you know how it is. People will work with you or want to do business with you after they see you have a proven track record, right? After they see you've already attained a success. That's just how it is, you know? They don't want to work with you if you're just doing something brand new, unless you're just an excellent salesman. But people like to see that you actually have some success before they want to partner with you. And then once they see the success, they start knocking on your door, asking to partner or to lend you money. Because there's people out there that just want to give you money. Trust me. That's one of the things you should confess. That people love to do business with me. People love to give me money. Banks, creditors, private money, partners, the whole shebang. Sellers as well. All right, so I hope this is successful and beneficial to you guys. And last thing I want to say is thank all you guys for giving me feedback. Whether it's positive or negative is greatly appreciated. If you have any questions, contact me via email or give me a call. And also, if you want any content or anything explained, just shoot me an email and I'll create a video for you, okay? And I'm thinking about, as well as starting like a monthly, I don't know if I want to do like a conference, a teleconference, or a video conference, or a webinar for my subscribers. So make sure you subscribe. And shoot me an email if you're down for that, if you think that'll be beneficial. But I'm Juan Pablo. This is to your success. Love you guys. Peace.